Hello everyone, welcome to my channel. This is Easy Accounting channel. Today we are studying IFRS 10, International Financial Reporting Standard 10, Consolidated Financial Statements. How do we prepare consolidated financial statements? A parent prepares consolidated financial statements using uniform accounting policy like transactions and other events. However, a parent need not present financial statements if 1. It is wholly owned by another entity. Number 2. The debt and equity instruments are not traded in public market. And also, the financial statements are not filed with Security Commission, and also the financial statements are not available for public use. So what are the consolidated procedure? Number 1, we combine like with like, the assets, the liabilities, the equities, the income, expenses, and cash flow of the parent with those of the subsidiary. So we offset the carrying amount of the parents in each subsidiary and the parent portion of the equity. Then we eliminate in full intra-group assets and liability, income and expenses between the entity. So a reporting entity include income, expenses of a subsidiary in the consolidated financial statement from the date it gained control until the date that it ceased to control the subsidiary. So we have to combine the income, expenses of the subsidiary based on the assets and liabilities recognized in the consolidated financial statement, and then the parent and subsidiary are required to have the same reporting dates, and also there should be no more than 3 months between the subsidiary and the parent for their financial reporting, and they should use the updates that is the subsidiary financial statement. So the non-controlling interest, so a parent present non-controlling interest in its consolidated statement of financial position within equity. So a reporting entity attribute the profit and loss and each component of other comprehensive income to the owner parent. So when changes in ownership interest in a subsidiary do not result in parent losing control of the subsidiary. However, the proportion of the equity held by non-controlling interest changes and the carrying amounts of the controlling and non-controlling interest are adjusted. So if a parent loses control of a subsidiary, 1, it has to derecognize the assets and liability of that subsidiary, and also it has to retain the investment in the former subsidiary when the loss is lost, and also it has to measure and remeasure the value of the fair value of the assets. So investment entity consolidation exemption. So IFRS 10 contains special accounting requirements for investment entity. So an investment is a subsidiary is measured at fair value through profit and loss account in accordance with IFRS 9 financial instrument or IAS 39 financial instrument recognize and measurement. Disclosure. There are no specific disclosure in IFRS 10. Instead, IFRS 12 disclosure of interest in other entity outline are required. applicable or early adoption. So IFRS 10 is applied to annual reporting beginning on or after January 1st, 2013, and we can do it retrospectively with accordance with IAS 8 accounting policy, changes in accounting estimates and error. So IFRS 10 prescribe modified accounting on its first application in the following circumstances. Number one, an entity consolidates an entity not previously consolidated. An entity no longer consolidates an entity that was previously consolidated, and in relation to amendment to IAS 27. So an entity may apply IFRS 10 to an earlier accounting, but if doing so, it must disclose the IFRS 11 joint arrangements, IFRS 12 disclosure of interest in other entity, IAS 27 separate financial statement, and IAS 28 investment in associates and joint ventures. Thank you for coming to my channel. Please subscribe to my video, and I hope to see you in my next video. Thank you. Bye.